Hi, everybody, and very good morning to you. Looks like we've got most people in now, so we will make a start in the interest of keeping within the hour that we've got today. Welcome to this morning's Accentuate by K3 Hub webinar, where we'll be covering two topics, the current R&D tax relief landscape and latest HMRC enquiries trends. For those who haven't virtually met me before, my name is Marie Wadeson, and I'm a Managing Director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I lead the K3 Hub, which is a member network for professional advisors, which has been developed by group companies within the K3 Capital Group. By way of a bit of background, K3 Hub launched probably just over 4 years ago, actually, and we're very proud to have over 3,500 members who regularly join us for our CPD and training sessions. So thank you for being with us for so long. A few pieces of housekeeping before we get into today's session. So you've probably noticed as you've joined the webinar that we are recording, the webinar will be placed on the K3 Hub and Quantuma websites, and I think on this occasion it is going to be placed on the randd website as well. So watch this space. They should be posted at the very beginning of next week at the latest if you need to refer back to anything. Q&A function is open. Do feel free to ask questions as we go. Now I'm going to put your questions to our speakers today. Because we've got two different speakers, I'm going to do two sets of Q&A. So we've got Adam from who's going to cover an R&D update for us. I'm going to cover his Q&A after his session. Jeremy on tax investigations, I'll cover his Q&A after that session. So if you've got questions as we go along, please do ask them. If you could use the Q&A just so I've got everything in one place so that I'm not looking in the chat as well, I'd be really grateful to you. Preference is that, as I said, that you do use Q&A rather than the chat, just so I can keep everything together and stay on top of all of your questions, of which we have had quite a few in already. Likely that we will get quite a lot of questions. If we don't manage to get through all of them today, apologies in advance. I will pass them on to the relevant speaker and they will come back to you separately. Right, so on to today's webinar then in that case. So I'm very pleased to welcome Adam Bointon to today's session. Adam is a colleague of mine from our sister company randd, which is an R&D tax credit specialist, and our sister company here at Quantuma. He regularly advises SMEs and accountancy firms on preparing and submitting successful claims for R&D tax credits. In particular, Adam helps clients in both the manufacturing and software sectors to identify research and development activities within their business and converts highly technical information into reports that the layperson can read. Adam, over to you.
Thank you, Marie. Yes, hi everyone. Yeah, I'm Adam. I'm the technical director at randd UK, where we work closely with accountancy firms and businesses across the UK to help them access R&D tax relief in a way that's compliant, efficient, and as stress-free as possible. Over the next 30 minutes, I'll be walking you through the current landscape of R&D tax relief, including the most recent changes, what challenges firms are facing, like HMRC's increased scrutiny, and how you can continue to support your clients with confidence despite all these challenges. I'll wrap up the first session with a Q&A, so make a note of any questions you think of as we go along. So if we move on. So the R&D tax relief landscape has changed a lot over the past couple of years. One of the largest changes we've seen is the merging of the SME and the RDEC schemes into a single unified scheme. This was first confirmed in the autumn statement back in 2024. The purpose of this is to streamline the process and make it easier for the firms and businesses submitting for relief. Claims with an accounting period that start on or after the 1st of April 2024 must now be prepared using the merged R&D RDEC scheme. It's important to recognise that the rules can vary depending on the nature of your business and the contractual arrangements under which R&D is being conducted. For SMEs, a key first step is determining whether you fall under the R&D intensive incentive or the new merged scheme. So to qualify as an SME for R&D tax purposes, the company must have fewer than 500 employees and either an annual turnover not exceeding 100 million or gross assets under 86 million. You'll also need to determine where the responsibility for initiating R&D resides. In most cases, if your company is carrying out R&D under a contract for another party, meaning the decision-making and risk lie elsewhere in the supply chain, they may not be eligible to make a claim. A key update is that overseas costs are now largely excluded unless they meet a very narrow exemption criteria. So if a business is carrying out R&D activity outside the UK, even for valid commercial reasons, these costs may no longer qualify for relief. So this is quite common in software, for example. We've also seen greater clarity around what HMRC considers eligible R&D. It sounds helpful on paper, but in practice, it's created a more rigid framework, meaning firms need to be confident that every project and cost align clearly with the guidelines. However, there was an issue with HMRC's guidance on subcontractor costs in September last year. They've since acknowledged this mistake and as a result have opened up a limited window for affected companies to revise and resubmit claims. So if any of your clients you know of or any businesses that may have been impacted by this, it's important to act now before this opportunity closes. Okay, so if we move on. So other major changes include the new compliance obligations introduced by HMRC. And a key aspect of this are two key documents that are now central to every claim. And they are the additional information form, usually referred to as the AIF, and the advanced notification form, referred to as the ANF. So let's start with the additional information form. The additional information form has been mandatory for all claims submitted from August 2023 onwards. This requires detailed technical and financial information up front, including details of the R&D project. So specifically, you are required to identify the main field of science and technology that relates to the project, the baseline level of science or technology that the company planned to advance, and what technological or scientific uncertainties were being addressed and overcome during this work. You'll also need to detail and identify the eligible expenditure per project for which you are claiming. And importantly, if you don't submit an additional information form, the claim will automatically be rejected. So if we move on to the advanced notification form. So the advanced notification form, or the ANF, is required for companies that haven't claimed before or haven't claimed in the last 3 years. There's some technicalities about whether those claims are an original or an amendment. So if the R&D claims have been formed as part of an amendment, our advice is to always submit an advanced notification form. It acts as an early declaration of a company's intention to claim R&D tax relief for a particular accounting period. This form must be submitted within 6 months of the end of the accounting period to preserve eligibility. So, for an accounting period that ran from the 1st of January to the 31st of December 2024, you would have until the end of the 30th of June to submit the ANF. So that's quite important for this month. December year ends are very common, so the 30th of June would be the deadline for those. Missing this deadline will mean you cannot claim R&D tax relief for that period. So these requirements were introduced to reduce errors and deter abuse of the scheme. But they also mean the process is less forgiving, especially for firms unfamiliar with the technical side of R&D. So if we move on. So because of these factors, understandably, many accountancy firms have chosen to step back from or hesitating to introduce or reintroduce R&D services as one of their offerings. Some of the main reasons for this are because they believe the rules are changing too quickly or are too confusing, and it takes too much time to try and keep up with these changes in addition to their regular work. Many firms also lack the technical knowledge required to confidently assess eligibility, especially across multiple different sectors. And there's a concern about inadvertently submitting non-compliant claims, not due to bad practice, but simply from not having the resources to go into the necessary depth. And finally, they typically don't want to risk any sort of reputational damage or financial damage if claims are rejected by HMRC. So if we move on, another major aspect of the R&D landscape is increased HMRC scrutiny. So HMRC dramatically increased its scrutiny of the R&D claims over the past year to 2 years as part of its strategy to reduce fraudulent and erroneous submissions. In 2023-24, the inquiry rate reached nearly 17%, meaning nearly 1 in 5 claims face some form of investigation. We're seeing more claims under inquiry, more requests for detailed documentations, and far fewer allowances for vague or boilerplate narratives. So this has raised the bar for all submissions, even those made in good faith. Investigations are typically launched within 12 months of a claim being submitted, and if HMRC isn't satisfied with the eligibility of the project or the amount claimed, they can and do open a formal inquiry. While some view this as a deterrent, it is also an opportunity because firms and advisors who get this right can clearly differentiate themselves by offering a credible service that so many have abandoned. So what are the main red flags that are likely to trigger an inquiry? So typically there are 3 main ways an inquiry might be raised. First one is random selection. There's the mandatory random inquiry program, or the MREP, which randomly selects to test overall compliance within the system. This will affect all sectors and all sizes of claims. There's the volume-based selection, where HMRC target claims from specific sectors or claim profiles that are generating a high number of submissions and they're experiencing high rates of non-compliance in those sectors and types of claims. And then there's a discrepancy-based selection, where something in the claim itself appears erroneous and raises a red flag, such as inconsistent figures, vague project descriptions, or ineligible costs. So the biggest risk we see right now is firms managing to try this alone without the right expertise. So even with the best intentions, it's easy to sort of miss submission deadlines, misinterpret eligibility criteria, or submit incomplete documentation that leaves the claim exposed to inquiry or rejection. So mistakes, even innocent ones, can have pretty serious consequences, not only financial but reputational. And while some firms have chosen to walk away from R&D entirely, that isn't the only option. So moving on, partnering with randd UK is designed to be a simple, collaborative and low-risk approach, allowing accountancy firms to expand their service offering without overstretching the internal teams or exposing the firm to resource-intensive compliance issues. And here's how it works in practice. So you introduce us to a client, and this could be either when a relevant opportunity arises or if you'd simply like us to assess their eligibility. You maintain full control of the relationship, and we operate strictly as a specialist partner. We take care of the technical and compliance workload, including gathering the necessary project and financial information, conducting all the required technical interviews, and preparing a detailed narrative and R&D report. We'll also prepare and submit the additional information form on your behalf. We stay fully aligned with the current HMRC guidance to ensure each submission is robust, detailed, and audit ready. You remain the client's lead advisor, meaning your firm retains the trusted relationship and reaps the benefit of offering a high-value service without needing to develop an in-house expertise or team and manage complex claims process. So we basically act as an extension of your own team, not as a competitor, and to provide you with confidence that your clients are receiving expert support whilst protecting your firm's reputation and resources. With randd, there's no obligation to retrain your team or take on additional resources. We can provide firms with access to R&D specialists with sector expertise, including automotive, construction, food and drink, engineering, farming, etc. The randd team are prepared to come in and help at any point of the claim process. We also typically do our visits in person to maintain a close relationship with clients. So whether this is from the very beginning and you need support post-submission with an inquiry defence. So we're more than happy to assist in claims that we've not even prepared ourselves. And if a client, especially if a client finds themselves in an HMRC inquiry. So please feel free to reach out if that is the case. Moving on. So as I mentioned earlier, there's a real opportunity here for firms to step up and make themselves leaders in their industry. R&D tax relief is still lucrative for businesses when claimed properly. It's a very important incentive that's been championed by the Treasury. So there's every reason to find a solution to offer R&D services for your clients. So with so many firms stepping back, there's a gap in the market for those that can offer high quality R&D support. Also, with the increased scrutiny from HMRC to get claims right the first time, having the right support makes that far more achievable. You also don't want to have to turn away clients because you think you don't have enough expertise to prepare a successful claim. And while it's absolutely important you're able to recognise if you can't offer this service to as high a standard as your clients deserve using the firm's current resources, it doesn't mean that door has to close. Delays, rejections and penalties are all causes of strained client relationships. So why not introduce a specialist consultant as part of your team and minimise that risk altogether? Okay. So that brings us to the end of the presentation. If you've got any questions, I'd love to hear them now. And if there's something we don't have time to cover today, we're always happy to follow up with a conversation, a blog post, and even a future webinar. So thank you.
Thank you very much, Adam. That was excellent. We do have some questions for you, so I'm going to put you through your paces. So bear with me. Right. So I'm going to read them as they have come in. So first question reads, is it common experience for HMRC to reject all CT submissions with R&D claims on the basis of missing supporting information, regardless of whether this is filed or not, and also for HMRC to take many months to even respond to appeals?
Yeah, okay, I suppose it depends what you mean by reject, the CT submission and supporting information. If a CT submission with an R&D claim is incomplete when it's filed, i.e. the additional information form is incomplete or not filed at all, then it always runs the risk of HMRC either revenue correcting it or opening up an inquiry into the validity of the R&D claim itself. The additional information form is a requirement. So if it's not complete, then it will not pass HMRC's initial automated inspections. If the AIF has been filed correctly and the claimant chooses to support additional information in the form of an additional R&D report, for example, or additional evidence, then it is not necessarily certain that HMRC would reject the claim at all. In this instance, HMRC may process and pay the claim out, but if the supporting information is never filed within the inquiry window, if you've suggested that further information was to follow, then this is sort of typically 12 months, a 12-month inquiry window after the amendment or the tax was due, then you may find HMRC open up an inquiry sort of at the last minute. So it is important to know, you don't need additional supporting information in terms of extra evidence or support, as long as the additional information form has been filled out correctly. But if you suggest that you're going to file extra stuff, then, if you don't do it, then HMRC might indeed open something up.
Great, thank you very much for that. And the last question that I've got for you here, and again, I'll just read it as it's come in. What is required for a firm to prepare its own R&D claim? Why are we better to use specialists?
Yeah, a company can indeed prepare its own R&D claim, and we often see that quite common. they can prepare that and submit their claim through their accountant or by the HMRC portal. As long as all the information in the project expenditure is prepared correctly, them and their accountant can complete the AIF on their behalf. That's not a problem. But in our experience, though, unless the project leaders within the company have a good grasp of the sort of CERD guidelines and understand what HMRC really mean as R&D for tax purposes, then they can often come unstuck when HMRC do open up an inquiry eventually on that business. Also, ineligible or uncredible expenditure, can be included sometimes, which can also raise an inquiry because it raises inconsistencies on the expenditure side. So I suppose it's important to remember that just because HMRC haven't raised an inquiry in the past, it doesn't necessarily that they have sort of approved each and every claim that the company has submitted. And it's actually a common misconception, really. It's just probably that HMRC have not reviewed that claim at all. It's just simply passed the rudimentary checks on submission and then be paid out. So using a specialist helps mitigate these errors in the first place. And also, if it comes to an inquiry, the claim is in a much better position to be defended. Say, just because an inquiry has been raised doesn't mean any wrongdoing has actually taken place. It can be random, and you can just fall foul of a particular selection criteria. So in fact, most inquiry defences end up being passed with no amendments from the original submission being made, as long as it's been prepared correctly in the first place.
Lovely. Okay, I've just had a flurry of new questions for you. So we go on. So question from Peter here. If a claim is rejected in year one because the claim was late, can it be claimed in the following year?
I think it depends on if an ANF has been filed. So that claim, even if it wouldn't have been an original, so it would have been an amendment, and so they HMRC don't class that as a previous submission, and if it was late anyway. So if you've claimed in the previous year and it was rejected because it was late and you've not submitted an ANF, then it is unlikely it can be claimed for in the following year because you've not notified HMRC of your requirement to make that claim.
Okay, and one other question, and again, I'll just read it as it's coming. So we have a 2021 claim that HMRC has agreed can be processed. However, despite chasing, we get no feedback from them of when the payment will be made. Any suggestions of how we can put pressure on HMRC?
Yeah, I mean, we encounter this quite frequently. Again, HMRC can quite often not notify anybody of any information. Keep checking the government gateway to see if anything's been pushed. But ultimately, one way of doing it is to eventually get your customer, the customer, as HMRC referred to the company themselves, to apply pressure. Us as agents, we only get so far. Once the customer starts to get involved, then that typically raises the bar for HMRC to respond. So that would be your next step. Beyond that, yeah, you could potentially escalate it, raise a complaint, but I'm not necessarily sure that's a great idea because that could even prolong the process even more, if you know what I mean. But yeah, get the customer involved, which is the client, and get them to respond to HMRC and chase up directly.
Great stuff. That's great tips there. Final question for you then. Can you submit an ANF, but then when you have looked into the potential claim, can you find that it wouldn't sorry, I'll start again, right? Can you submit an ANF, but then when you have looked into the potential claim, you find it wouldn't qualify? Would that flag up?
Yeah.
Would that flag up inquiries if you submit a lot of ANFs?
Yeah, so there's no obligation to actually file an R&D submission, even if you've done an ANF. And actually, the ANF is typically a broad interpretation of the R&D project that you're seeking to submit anyway. So the nature of that R&D project can change from the ANF. So, and if you've decided that actually, in the end, we don't think we've met the CERD criteria, then there's absolutely no obligation to submit an R&D claim at all.
Okay, lovely. one final one for you, and I keep saying this. I've just got one final question for you. So you mentioned that HMRC can look back at previous years if they investigate and don't like a claim. If a dual report and calculation has been submitted for previous years, surely those are protected by 12-month investigations limit, and HMRC have missed their opportunity to inquire as they have all the information needed.
That's broadly correct. Yes. So the interpretation of the case law here is that you've given HMRC all the information that they need to open up an inquiry within their inquiry window, which is that 12-month window after amendment or tax due. And yeah, I mean, the only chance really they would do it is if they suspected some degree of fraud in that. So as long as the claim is made in good faith and is representative of the R&D project in particular, yes, HMRC have missed their inquiry window once that 12-month window has passed.
Okay, great. Thank you for clarifying that. Right, I'm gonna call an end to your session, Adam. Thank you very much for joining us today, making your debut on the K3 Hub, and we hope to have you back in the not too distant future. So I'm going to move on to our next speaker. So I'm very pleased to be able to welcome back Jeremy Johnson. Jeremy is a good colleague of mine, works with me in the London office, and is managing director at Tax Investigation Specialist inTAX, also a sister company of Quantuma, and obviously part of the K3 Capital Group. He provides advice to clients on a range of matters, including disclosures of errors, running fraud inquiries, conducting appeals and tribunal work, and alternative dispute resolution. He has extensive experience and understanding of the workings of HMRC, which gives him a unique insight into how to approach and work with them. Jeremy, welcome back, and over to you.
Thank you very much. Thank you for the kind introduction, Marie. Good morning, everybody. I hope you're all well. I'm going to cover a couple of things today. First of all, I'm going to give just a general update on a few areas where HMRC is active or where there are changes. And then secondly, I'm going to cover a relatively new piece of legislation which allows HMRC to make directors, shadow directors, participators jointly and severally liable for a company's debts where there may be an insolvency procedure. So HMRC is piercing the corporate veil. So on the next slide, a few bullet points of kind of general topics of possibly interest. The first being side hustles. I've had a few rants about the reporting on side hustles and new side hustle taxes. There is no new side hustle tax. The rules around what you should be reporting and whether you're trading and whether you're not trading are the same. What has changed over the last couple of years is that platforms are reporting data to HMRC. So Amazon, for example, or eBay or whatever. In fact, we had a client come to us recently because eBay notified that individual that because of the number of or the value of transactions, I think it was above £4,500 in a year, they notified this individual that they would be reporting all of the data to HMRC. That prompted the individual to think, am I trading? Do I have a tax liability? And they came to us. So the change has been in the reporting. HMRC is getting more data. It's causing them to open inquiries or send nudge letters. One thing that we have noticed, and if any of the accountants on this call do prepare accounts for people who do trade on the likes of Amazon and eBay, depending on what information individuals share with you, that there's quite a lot of opportunities to get things wrong. For example, we've had a client who sold a lot on eBay. And they would report themselves their sales to their accountant, but what they were reporting was the money that arrived into their bank account rather than the actual turnover. Because the way that Amazon will work, for example, is if I sell £10,000 worth of goods in a month, Amazon will keep £1,000 for their fees. They may also keep £1,000 against any future returns. And what they'll transfer to me is £8,000. And if I'm reporting the £8,000 as my turnover, it's incorrect. You may wind up getting the same answer, but if you do have clients who work in that world, it's probably useful to see the source data, because there's a lot of opportunities to get it wrong. So yeah, HMRC has got the data and they are opening inquiries. On similar lines, crypto, from next year, HMRC is going to be requiring crypto platforms to share data with HMRC. So HMRC will be more widely cited on transactions that individuals have undertaken, meme coins or digital coins or whatever it may be. But what's also interesting is that that's part of an international effort. So there will be international information sharing. So various exchange or various countries, jurisdictions around the world will be gathering this same data. If they find that they've got a customer who is resident elsewhere, they will be sharing that data with that other jurisdiction. So not only is HMRC going to be getting information about UK resident individuals who have used a UK platform, potentially they'll get information about UK resident individuals who have used a non-UK platform. So more and more data in the fullness of time will probably lead to more nudge letters, more inquiries, etc. The Let Property campaign has been around for a long time. It still produces anywhere between 1 and 5 inquiries for us every week, which seems fairly surprising given how long the Let Property campaign is going on, that people are still out there with rental income that they haven't disclosed and HMRC hasn't found them yet, although in some cases they do get a nudge letter. The other thing to say about that is probably at least 50% of the people who come to us quite credibly didn't understand that they had a reporting obligation in relation to that income tax. A lot of people come to us absolutely terrified that they've been doing things wrong. They haven't been reporting their rental income. Obviously, they're keen to put it right. I don't know what HMRC can do about that, whether there's some piece of general awareness. But there are still lots of people. The campaign is pretty easy to use. It's pretty straightforward and relatively pain-free. Obviously, tax to pay at the end of it. But there are still plenty of people out there who are receiving rental income, and they've just never realised they should disclose it. And again, the WDF, that's been the Worldwide Disclosure Facility. So where you've got income or gains outside of the UK and you haven't reported them in the UK, or you've reported them incorrectly, that's been going for some time, and that continues. Anecdotally, and this could just be coincidence, we've had a couple of recent cases which follow a similar pattern where you've got senior employees in the UK of a large organisation which is headed outside the UK. So, for example, US parented corporate, and senior employees in the UK may be part of some kind of share scheme. So they may get shares vested every so often as part of an incentive scheme. But then the shares, if they retain the shares and potentially those shares are paying dividends, those shares are held outside of the UK, you know, in the US, in Australia, or whatever. HMRC's had information about those shares being held and has sent a nudge letter to individuals completely unaware. They probably should have taken some advice, but completely unaware that this thing that kind of sits separately as a long-term incentive plan. They haven't sold shares, but they do actually have some reportable income outside of the UK. So if any of the accountants here do happen to prepare tax returns for senior individuals in corporates, it's worth asking the question about any share vesting or long-term incentive schemes, because it might have been missed. So that's a general update on a few areas that HMRC is you know, continuing to work in. I'll move on now to the topic of joint and several liability notices. This is relatively new. So this was in Schedule 13 Finance Act 2020. And this is aimed at making officers, and we'll come on to what officers are, or people with a relevant connection, jointly and severally liable for a corporate's tax debt, and that's all taxes. They're targeted at where a company is in an insolvency procedure, or there is a serious possibility of it becoming insolvent. And the context for this is what HMRC was trying to do was tackle what it perceived as certain areas of poor behavior, companies ending up with a tax debt, and then the company disappearing and the tax never being paid. So the legislation was introduced so that HMRC could come after the individuals, so that the concept of leaving behind a debt in a company couldn't happen. That there is, that the debt is going to come home to roost. So there are three general scenarios that HMRC can use this new power. One is in cases of tax avoidance and evasion. The other is in cases of repeated insolvency. And the final one is in relation to facilitating avoidance or evasion. So I'm going to cover each of those three scenarios and the basic conditions that have to be present for HMRC to issue the notices. I'm afraid that my slides are a little bit denser than I'd normally like them to be, but unfortunately it's a relatively dense piece of legislation, and it's quite a bullet point piece of legislation, which will become apparent with lots of conditions. So in relation to the first scenario of tax avoidance and evasion, the next slide covers the basic conditions. So an individual can be sent a notice if all of these conditions, A to E, are met. So firstly, the company has to have entered tax avoidance arrangements or engaged in tax evasive conduct, and I'll come on to what those two things mean in a minute. The company has to be subject to an insolvency procedure, or there is a serious possibility of that happening. I assume a serious possibility is likely to be they've run up large debts with HMRC. This is why HMRC is possibly interested already. And, it really looks like the company is going to fall off a cliff. The third condition is that the individual responsible for A, when they were either a director, shadow director, or participator, so participator shareholder, or they were managing, so they don't have to have been a paper officer of the company, or they will knowingly benefit from the tax avoidance arrangements. I don't know why HMRC put in knowingly benefit, and whether there's a likely circumstance when you're not a participator or managing or a shadow director and you'll knowingly benefit. But if you'll knowingly benefit and you weren't involved directly in the running of the company, you could still be caught by this. There's likely to be tax that's referable to the avoidance or the evasion, and there's a serious possibility that some or all of the relevant tax won't be paid. So in terms of what's the definitions of some of those areas, on the next slide, tax avoidance, broadly speaking, if it's been tackled using the general anti-abuse rule, you're going to fall within the ambit of definition of tax avoidance for the purposes of this legislation. If a follower notice has been given, then it's considered tax avoidance. Broadly speaking, DOTAS arrangements, so disclosures of tax avoidance schemes arrangements, will be covered by this. And also arrangements where the tribunal has ordered a company that their arrangements should be disclosable under the DOTAS legislation, or where that order has already happened and there are similar arrangements run by the same promoter, that sucks that tax avoidance into the definition of tax avoidance for the purposes of this legislation. So that covers the tax avoidance part of what is this legislation looking at. On the next slide, we've got tax evasive conduct. So we're talking about fraud, and in most tax legislation where you've got the word deliberate, you're looking at fraud. So deliberately giving HMRC an inaccurate return, claim, document, or information, or deliberately failing to notify. So you knew that you should tell HMRC something, but you didn't, or you knew that documents that you gave to HMRC were incorrect, but you still did it. So broadly engaging in fraud. The second scenario, so just to recap on that, avoidance and evasion, you're involved in it, the company looks like it's going to go pop, potentially you could be issued with a notice, so that debt wouldn't necessarily die with the company. The next scenario, which is on the next slide, is cases of repeated insolvency and non-payment. And you have to bear with me on this one because it's a little bit complex. And so this area, HMRC is clearly trying to tackle what it would perceive as being effectively phoenixism. So people operating a company, running up tax debts, leaving the company behind, starting a new business, doing the same thing, and doing it again and again. So in terms of the general criteria for HMRC to be able to issue a notice for repeated insolvency and non-payment, we've got all of conditions A to D need to be met. So the first condition A is that there are two old companies, and the individual has a relevant connection to those companies within the last 5 years, and both of those companies went into an insolvency procedure owing tax or had failed to submit returns. So two, and it's at least two. So at least two old companies that have become insolvent owing debt, and the individual within the last 5 years has a connection to them. Condition B, there is a new company that carries on the same or a similar trade as each of these two old companies, or any of the two if there are more than two. So you've got the same business effectively. The individual has a relevant connection, and I'll talk about what relevant connection is in a second. The individual has a relevant connection with the new company within the last 5 years. So two old companies have gone pop. New company, it hasn't necessarily gone pop. It may or may not have a tax debt, probably more likely to get a notice if it does have a tax debt. But you've got the same trade and the same individual kind of following through this. And then the final condition D, at the point when the notice has been given, and when I was looking at the slides, I've slightly mistyped this, but the companies together, it's not at least one of the old companies. The old companies together have a tax liability of over £10,000, or had a tax liability of over £10,000. And also the tax liability amounted to, in aggregate, more than 50% of the unsecured creditors. So old companies have gone under, owing tax, together more than 10,000, and that 10,000 or whatever number it happens to be represents more than 50% of the unsecured creditors of those companies. In terms of some of the definitions there, so if those conditions are met, then the individual is jointly and severally liable with the new company for any tax liability that the new company has now and for the next 5 years if the notice remains in force. So it's almost, but potentially you could see that this is a sword of Damocles. If you've had a couple of old companies that have gone pop and you're now running a new company that's similar, and you get one of these notices, you could be responsible for the new company's debt personally. If the old company still exists, they might have gone into a liquidation procedure at some point. If the old company still exists and they do still have debts, then the individual can become jointly and severally liable for the old company's debts. And the relevant connection in terms of the individual's relationship with the companies. For the old company, director, shadow director, participator. For the new company, director, shadow director, or participator, or just concerned in the management. I'm not sure why that's that slight distinction, but it does exist. We've seen a couple of these cases now within our team in this scenario, repeated insolvency, where people have come to us because they have had business. In fact, in both of these businesses ended up being really affected by COVID. And we've got a couple of situations where directors did what they could, put their own money into companies. It went under, tried again, it went under. They're now involved in a third company, and they find themselves facing one of these notices, making them personally liable for debts which probably, you know, weren't attributable to poor behaviour. We've successfully defended one. The other is probably on its way to tribunal, and we'll see where that goes. So moving on to the third scenario where a joint and several liability notice can be issued. This is where there's been a penalty for facilitating avoidance and evasion. And again, we've got this bullet point list of conditions. All of A to D must have been met for HMRC to issue a notice. So a penalty has been imposed, or there is a case on its way to the tribunal relating to such a penalty. The company is subject to insolvency, or looks like it very well might be. The individual was a director, shadow director, participator at the time where the act which causes the penalty happened, and there is a serious possibility that some or all of the penalty won't be paid. So a slight nuance with this one. It's not strictly a tax liability. This is a company's penalty liability, but again, it can be moved to the individual. The next slide covers some of the conditions that sit behind that. So in relation to the penalties that HMRC can impose that they can then move to an individual, breach of DOTAS obligations, there are various avoidance scheme promoter penalties which can be moved. Penalties for enablers of offshore tax evasion, penalties for enablers of defeated avoidance, so those people who try to continue to sell a scheme that's already been defeated in the tribunal. Penalties for facilitating avoidance schemes involving non-resident promoters. So quite a lot of the payroll schemes were based offshore. So if you're involved in promoting that in the UK in some way or selling it, you could find yourself in the frame for a penalty under this bit of legislation. So to wrap up on that JSLN, oh, forgive me, sorry, there is a further one, some miscellaneous points in this. You can obviously appeal the penalty. If an individual has had a penalty in relation to the situation that's caused the tax debt, if the individual has individually had a penalty, the notice will be reduced in value. So you can't end up being doubled up on this. Also, an individual who receives this notice can be party to any appeal that the company wants to run against the underlying tax liability. And even if the company doesn't want to run an appeal against the underlying tax liability. So for example, if the company is in liquidation and the liquidator is not particularly interested in conducting any appeal against a tax liability, the individual who's received the joint and several notice can actually conduct the appeal as if they were the company to try to reduce the tax liability. Also applies to LLPs. And effectively, member or shadow member is the same as director or shadow director. So you've got these three scenarios where HMRC is seeking, in circumstances where HMRC believes that there's been some bad behaviour, seeking to move the debt from the company to the individual. And that's the end of that in relation to my part of the morning, Marie. I'm not sure if there are any questions, but I'm obviously happy to take them.
Lovely. Thank you very much, Jeremy. It sounds like there is never a dull moment in tax investigations, with plenty to update everybody on today. Thank you very much for that. It was great. I do have some questions for you, so we shall move straight on to those. So the first question reads, a question for Jeremy. So with regards to nudge letters, what's the best response where the client has done things right, i.e. HMRC are barking up the wrong tree? HMRC has sent an extensive information request as part of the nudge letter.
I mean, if it's an informal information request, you're not obliged to respond to it. I wouldn't suggest that you wouldn't respond to it. If you know that everything is right, I think, and this is in very general terms, it's not specific advice, as well as responding to the information request, and HMRC might be asking for things that's not relevant. I'd probably be going beyond that and explaining exactly what happens and why everything is okay. Here's the information you wanted, HMRC. Maybe even there's more information that you would wish to provide that they haven't asked for that demonstrates that everything's okay. Go ahead and provide it, and just write and explain this is why there isn't a problem.
Great, thank you. Next question then. So how does HMRC interpret the issue of connected parties in this instance, and what tests does it apply to establish an individual as being a shadow director?
Yes, it's an interesting question. And, what evidence would HMRC have to gather to show that you are a shadow director? So there might be things like if you were a signatory to bank accounts, if your email signature says director, even though you're not a paper director, if there's evidence that operationally you are involved at a senior level, whatever that might be, you might be involved in dealing with the largest clients and doing quotes. Clearly, it would be down to HMRC to demonstrate that you were a shadow director. I don't think there's a definitive list of pointers to being a shadow director, but there are a number of things that you could see that HMRC might point to try and paint the picture that an individual is, they're not a shareholder, they're not listed as a director at Companies House, but they are significantly involved in running a company.
Great, thank you. Next question then from David. Is there any time limits for the notice to be issued? For example, a company entered liquidation in 2018, which had an EFRBS plan. Are the directors still at risk of a notice?
So you've got to have had a connection. So you've got to have had a connection within the last 5 years. So there is kind of a time limit there. There is also, I didn't put it on the slides, there's also another time limit as well, in as much as HMRC would have to issue the notice within 2 years of becoming aware of the situation. So HMRC can't go back forever. Yes, there are some time limits.
Okay, great, thank you. Last few questions, as I'm conscious of time here. So what is the trend of tax investigations for small limited companies? And I think this is in the context of normally family-run businesses. So the question goes on to read, I have dealt with a few cases for tax investigations for sole traders in the past, but not for limited.
Yeah, what is the trend? I think HMRC's own statistics would show that SMEs, that they haven't been, with the exception of R&D, obviously a lot of inquiries into R&D. HMRC's targeting of the SME marketplace has been pretty slow over the last few years. Their own statistics show that the amount that they're getting from compliance checks in that population is lower. I think they've admitted they haven't done as much for whatever reason. I think that will change, but for whatever reason, over the last few years, that is a population that hasn't been targeted as significantly as it has been historically.
Lovely, thank you. With regards to joint and several liability notices, so what happens if the time limit to appeal the tax liability has passed when the joint and several liability notice is sent?
Okay, so yeah, this is a situation where the individual might wish to take conduct of the company's appeal. So let's say there was an assessment which has created the problem a couple of years ago. It was never appealed for whatever reason. At the point when the joint and several liability notice is issued, the individual can make a late appeal. So within 30 days of the joint and several notice coming to the individual, as well as appealing that notice itself, the individual under, I think it's paragraph 15 of that bit of legislation, can appeal the tax liability. So even though normally it would be a late appeal, it's now in time because the joint and several liability notice has been issued.
Great. Okay. I've got one more question for you, Jeremy. It's on a very topical subject for us right the way across the K3 Capital Group. You just bear with me. I just wanted to flag a couple of webinars that are forthcoming. Next Friday, we have a 1-hour marketing masterclass. That's Friday morning. And on Friday, the 4th of July, we have a full-blown CPD session covering tax and AI, which is super popular. If you haven't had your invite, you can go on to Quantum and the K3 Hub websites and register there. We will be sending out more invites in the week ahead. So watch your inbox as well. So just coming back to this final very topical question then. So it revolves around crypto, Jeremy, which I know is one of our favorite subject matter when we're in the office. So will it always be capital gains tax on crypto for individuals, or could transactions be classified as trading income?
Most of the time, HMRC would view an individual buying and selling or holding for a period of time crypto. Most of the time, HMRC would view that as resulting in a capital gain, I think, as things stand now. HMRC's own crypto manual kind of points back to its own business income manuals and some of the old considerations based on old law around individuals who would trading in shares and securities. And the case law around individuals trading shares and securities. And historically, people used to claim to be traders, usually because they got a loss. And if they were trading, they could set the loss off against other income. The case law suggests that really you have to be doing something exceptional, like a full-time employed trader would do to be considered a trader. So most of the time, it's probably going to be capital gains tax. Doesn't mean that there might be some individuals who would be considered trading, but most of the time capital gains, I would say.
Super. Thank you very much for that. In the interest of time, I think we're going to wrap up there. We have had some additional questions. I will be sending those to our speakers separately. It's been flagged to me that there was one that came over yesterday evening that for Adam that I failed to address. So we are going to send that over to Adam very shortly. So all that leaves me to say is thank you very much for joining us. As I said at the top of the session, we are recording this session will be posted onto K3 Hub and the Quantum websites next week. And that's about it for today. Wishing you all a great weekend, and may this glorious weather last.